Today I'm going to be teaching you everything you need to know about getting started with trading futures. How's everyone doing today on this fine, amazing, exquisite, resplendent, splendiferous, statesque, aesthetical, pulchritudinous day? Yeah, those were some big words. So now that everyone watching knows that I know what I'm talking about, let's get straight to this video.
Man, let's get straight to it.
Now the first point, what are futures? They're basically another financial instrument to trade. Now what is a futures contract? I'm gonna be honest, you don't need to know that, alright? That doesn't matter. If you want to know, you can go on the search bar and search up what a futures contract is, and those nerds will explain it 10 times better than I can, but all that matters is that you can trade it. The amazing thing about the futures market is that there isn't a PDT rule like there is with the stock market. So you can start off with a small account and turn that into a decently sized port easier with futures compared to stocks and options. People might be thinking that futures contracts are similar to option contracts, but that is not the case at all. Now with option contracts, you pay to buy the contract and are then assigned the contract in return, and your account value goes down however much the contract is worth at the time of you buying it. Now let's say you have $100 and you buy a 30-cent option contract. You now have one option contract worth $30 and $70 cash. With futures, it works a little differently. When you buy or sell a contract, your account value doesn't go down at all. There is no set price for each futures contract like there is with an option contract or stocks. So how does it all work? Margin. You will need a certain amount of margin to open up a contract. Different brokers have different margin requirements to open up different contracts. Each contract will need a different amount of margin to open it because each instrument will move differently and is priced differently. Now, once you open up a futures position, your account value will go up or down depending on if you're in drawdown or not. While you have the position open, you must maintain this margin requirement that is stated by your broker. If your account value goes lower than the margin requirement times the amount of contracts that you have, your position will be liquidated. Do y'all get that? I hope y'all got that. Today I will be focusing on ES and NQ. I won't be talking about the boomer ass futures contracts like cattle or hog or weak, none of that, okay? I'm young. You will never catch someone my age saying,
"Hey yo, cattle is in a demand zone right now, I'm looking to buy it."
Or some like,
"Yo, the MACD and RSI divergence on hog is an easy play, this is basically free money."
hell nah. So since we're on the topic of margin, let's go through how much margin you need in your account to open up a contract. On Tradeovate, one S&P contract is $500. This means you need $500 in your account to open up one contract, long or short. On the NASDAQ, this margin is $1,000. Now with futures, there are two different contracts. There are mini contracts and micro contracts. Micro contracts move 10 times smaller than the mini contracts. And since they're 10 times smaller, you'll need a smaller margin requirement to open up one contract compared to a mini contract. The ones I'm talking about right here are mini contracts. The margin requirement for the micros are $50 for the S&P and $100 for the NASDAQ. Now these are just how much you need in your account to open up a contract and have that contract stay open. Now let's do an example. You have $1,000 in your account. You open up one mini S&P contract for $500. Price starts going against you and now you are down on your position. Your account value goes underneath $500 during this trade, and guess what happens? Your position will automatically get liquidated and your account value will need to go above $500 again to trade that same contract. Now you might be thinking, hey, I got $1,000, why don't I open up two S&P contracts and get the bang for my buck, you feel me? Like if price goes my way, I'm about to make twice as much money than what I would with one contract. That's not the case. The remaining $500 will be used as a cushion so your position doesn't get liquidated. If you open up two contracts with a $1,000 account, if price goes against you just the slightest bit, your position will get liquidated. Alright, now that y'all know about margin requirements, let's talk about how much ES and NQ moves while you're in a position. Each tick ES moves, your account value will go up or down $12.50. Now, what is a tick? Each tick is a price increment, whether it be up or down. This is the lowest amount price can move up or down. There are 4 ticks in a point, and each point is a whole value. So since you know each point is a whole value, doing quick maths, we can calculate that each tick is 25 cents on a futures contract. Since there's 4 ticks to a point, each point is worth $50. right? For micros, each tick is worth $1.25 and each point is worth $5. For NQ, each tick price moves, your account value goes up or down $5 and each point is $20. For NASDAQ micros, each tick is 50 cents and each point is $2. Now let's do the math on how much each contract will go up or down if SPY or QQQ goes up or down $1. Each dollar on SPY is 10 points on ES. So since we know each point on ES is worth $50, so doing quick maths, 10 times 50 is $500 every dollar SPY moves up or down, right? So your account value will fluctuate $500 every time SPY goes up or down $1 depending on your contracts. This is depending on your size, of course. This is one contract. Let's say if you have 10 contracts, it will be $5,000. Now each dollar on QQQ is roughly 40 points on NQ. So with quick maths again, we can do 20 times 40, which is $800 every $1 that QQQ moves up or down. So if you're trading NQ, you'll be making more money than ES if SPY and QQQ move exactly the same dollar to dollar. Keep in mind, you will also lose more money, so remember to manage your risk accordingly. Don't get too fixated on making more money. You can always lose more money. Think about that as well. Now let's talk about the pros and cons about futures contracts compared to options and stocks. Pros: unlimited day trades, no stupid ass Greeks. It's super simple. You get more data and analysis, more liquidity, better tax benefits. It's tradable 23 hours a day for 5 days, and you're able to make more money. Cons: you risk losing your whole account if the position goes against you in one trade, but this is only if you're completely stupid and you don't know what you're doing, right? Let's talk more about the pros. You know that there isn't a PDT rule, so you can do unlimited day trades unlike options and stocks. So you're able to turn a small account into a big account faster with futures. You can scalp, let's say you have a $1,000 account and you only take 5 trades, but in those 5 trades, you're only looking to scalp 4 points on ES, right? You might think 4 points is not a lot, but if you're trading minis, 4 points equals $200, right? So in 5 trades, you can make $1,000 just scalping 4 points on ES. All right, let's go to the charts real quick and see how easy 4 points actually is. Price comes into demand, you find buying. Let's say you go long right here. Bam, 4 points. 4 points is this small price fluctuation out of this huge move, right? You only scalped 4 points. This is $200, right? This is one trade, right? Price comes back, price pulls back, and let's say you go again, 4 points, bam, another trade, right? Price comes back into demand, you find buying, you go long, 4 points right here. 4 points is not a lot on ES, I'm gonna be honest. All right, you take in 3 trades, 4 points each, you find price comes back into demand, you find buyers, you go long, let's say right here. All right, bam, 4 points right here, 4 points, easy. Price comes back, 4 points. It's so easy to make 4 points. Keep in mind, I'm not saying risk your whole account just to make 4 points. I'm saying if you have a proven strategy and you're able to scalp 4 points very easily and consistently, then you can make more money trading futures. No stupid ass Greeks. Oh, is this a good one? You don't have to worry about theta decay. You don't have to worry about IV. You don't have to worry about why price is going your way on the stock, but your contract is staying at break even because IV has ramped down, or the gamma of your contract is going back to its mean and it's decreasing the value of your contract. You don't have to worry about none of that. Those Greeks are only there to make your trading harder and make it harder for you to make money in the markets and easier for the market makers to take your money. If you know how to use the Greeks to your advantage, you can finesse the market makers, but less than 5% of people who trade options really know how to use all the Greeks to their advantage and are buying optimal contracts to accelerate those Greeks to their maximum potential. More data. What do I mean by that? Now, in the futures market, your order has to go through the open market. There isn't any dark pools that hedge funds can use to manipulate prices or any of that nonsense. Everyone must go through the open market and you're able to see every single person's order through the time and sales. Now, with all this data, there's a style of analysis called order flow analysis. This is looking into the buying and selling at every single price point, and you can literally see how strong market participants are. I won't be going in depth on this because that's a whole nother video, but this is something you can only do in the futures market and not the regular stock market. More liquidity. This is self-explanatory. I don't think I need to explain this. Tax benefits. So if you're living in America, futures traders are taxed at 60% long-term capital gains and 40% short-term. It doesn't matter if you buy and sell in the same day. It will always be this way. But if you're trading stocks and options though, you're taxed at 100% short-term capital gains on every single day trade that you make. Tradable 23 hours a day. The futures market is open for 23 hours a day and is only closed from 5 p.m. Eastern Standard Time to 6 p.m. EST. Meanwhile, the regular stock market is open from 4 a.m. EST to 8 p.m. EST. This is counting pre-market and after-hour sessions, but if you're trading options or trading with large size, you can't be trading in those sessions, so it's really open from 9:30 to 4 p.m. for you. Now you don't have to worry about losing money from 9:30 to 4 anymore. You can now lose it 23 hours in a day. Alright, continuing on the pros list, you can make more money. How does this work? Let's say SPY goes up $1. On ES, you would make $500 for one contract. Now, how much would you need to make that same amount of money if you're trading SPY? You'd need 500 shares, and that equates to $200,000 when SPY is at $400. You would need to put up $200,000 to make $500. Meanwhile, you can have a $1,000 account and make that same amount with futures. I don't know about you, but I ain't got 200K lying around just to make a measly 500. You feel me? Now let's say QQQ goes up $1 now. On NQ, you'd make $800. That'd be the equivalent of 800 shares on QQQ to make that same amount of money, which is $240,000 if QQQ is at $300. The bang for your buck is in futures. Come to the dark side. I know you want to. Now let's talk about some of the cons with futures trading. When I say you risk losing your whole account, don't get scared so quickly, alright? This is only if you don't have a stop loss on your trade. If you don't have a stop loss on the position you are currently in, you're potentially risking your whole account. With options, this is not the case though. You're only able to lose 100% of the value of the contract you buy. So with options, you can never lose more than what you put in. Now with futures, if you don't have a stop loss and price goes heavy against you, then you risk losing your whole account because of that one play. But there's a solution to not have this ever happen to you. Use a stop loss. There's another con that I can think of off the top of my head, but I wouldn't even consider this a con. There's only one instance where you can potentially make more money with options compared to futures, and that is SPX index options. If your SPX contract goes in the money and your delta goes higher than a 0.5, only then will you be making more money. The max you can make for SPX going up or down 1 point is $100 per contract, but that's only if your contract is deep in the money and your delta is close to 1. Keep in mind your Greeks will change throughout the day. Another instance is near end of day and you play SPX 0DTE contracts. Since there's barely any extrinsic value on the SPX contracts, they're all dirt cheap. If you buy those contracts and your contract does go in the money, luckily, it will be purely intrinsic value and your premiums can go from $100 to $600-700 in a matter of minutes when SPX only moves a couple of points. Keep in mind this is super risky and you'll likely get the move wrong more times than you get it right, but there is a possibility of you making more money with SPX index options near end of day compared to ES futures. Also keep in mind that you'll have to deal with the nonsense price fluctuations when SPX has a small candle going against you and your contract drops 40% in seconds. Yes, I said 40% in seconds. Those are the only instances where you are making more money on options, but one of those instances is basically very close to gambling, right? All these index options pros are only good for SPX. If you're trying to trade the NASDAQ, you cannot trade the NASDAQ index because those options are so illiquid, it's not even worth trading. So if you want to trade the NASDAQ, you're forced to go to QQQ options and ain't nobody really trying to do that, you feel me? But with futures, you can go to NQ and make more money that way. Now, what are the best brokers for trading futures? There's so many out there, so what do you look for? You want a broker that is trusted, has low commissions, and has low margin requirements. I am only saying this if you already know how to trade. If you're new to trading, do not choose a broker that has low margin requirements because you are more likely to blow up that account than you are to double or triple it like you're expecting. that's not realistic. If you put $1,000 in a discount broker, you are more likely to blow it up. If you're new to trading, choose brokerages with a higher margin requirement, and if you're more experienced, choose brokerages with a lower margin requirement because you know what you're doing. That margin requirement is just a safety net for newer traders. So if you are a new trader, I recommend you go with a higher margin requirement brokerage compared to a discount broker. The two best brokers I would recommend are Tradevate and AMP Futures. So with AMP, they have the best commissions and cheapest margin requirements, so you're getting the best bang for your buck. The only thing I don't like about them is setting everything up. It's dead ass like hacking into a CIA database. I am not joking when I say this. They take their sweet ass time setting everything up if you're a new user, and just to make it better, they make sure that the process is super confusing. It usually takes around 2 weeks from the very start to being able to place a trade on a platform. Now with Tradevate, they have a very easy setup process, so if you don't want to go through that hassle, go with Tradevate. Tradevate also has their own platform that you can trade on, while AMP only routes your orders. AMP themselves do not have a platform of any kind. What AMP basically does is they give you the data and the logins to any platform that you require. Some platforms are better than others and some are more expensive. There is a free platform that they provide, but it isn't made by AMP themselves. They still provide very good platforms though, and I would recommend using them. One of them is called Quantower. Now going back to Tradevate, you still get cheap commissions and cheap margin requirements, but with AMP, it's just slightly better. So let's do a side-by-side comparison with AMP and Tradevate. Now with AMP, we can see the margin requirement for each S&P contract is $400, $1,000 for each NASDAQ contract. Maintenance is basically swinging positions, and you need 10K in your account to swing an ES contract, 15K for NQ. Now going over to Tradevate, we can see that it's slightly higher, $500 for an ES contract and 11K to swing. Right? NQ has the same day trading margins, but its swinging margins is slightly higher. Now going back to the presentation, what are the cons for Tradevate? One of the cons is actually a pro. They have their own platform to trade on, but you are limited to only using that platform. With AMP, you're able to use whichever platform you like. The same platforms that top hedge funds use, you can use on AMP. The same platforms that allow you to read order flow data more efficiently. If you're on Tradevate, you won't be able to read order flow data like you would on, let's say, Sierra Charts or Jigsaw Trader, for example. It might be there, but it'll be a super watered down version of it. It's like kissing your homies and comparing it to kissing your wife. It ain't the same. Your homies are definitely 10 times better, and you know it. Some of the pros of trading futures that I mentioned before are just not going to be available to you because your platform just doesn't support it. And with all that being said, thank you so much for watching this boring ass video. If you got it this far, make sure to comment shout out big booty Latinas for real, and on every one of those comments, make sure to comment for real underneath them. I gotta know who's real and got it this far, and who's fake and clicked off the video 2 minutes in. Like the video if you learned something new and you enjoy the content, I'd greatly appreciate it. Subscribe if you're new and you're trying to make this bread. I heard only certified bag chasers are allowed to subscribe. It's like a new rule that YouTube implemented like a few days ago. I don't know, check to see if you're one of them. But comment down below if you have any questions about the video, and I'll see y'all in the next one. Peace.